You've worked your entire life to build your retirement nest egg. You've made smart choices, saved consistently, and now you're finally at that point where you can actually enjoy the fruits of your labor. But here's something most people don't realize, and I mean really don't realize. One single tax mistake could drain tens of thousands or even hundreds of thousands of dollars from your savings, and I'm not exaggerating. Today, I'm breaking down the 5 biggest tax traps that will catch retirees completely off guard in 2026, and I'm telling you right now, you'll want to stick with me because at least one of these could be costing you money right this second. Let's get into it. The first trap is what I call the required minimum distribution catastrophe. Now, once you turn 73 years old, the IRS says you have to start taking money out of your traditional IRAs and 401ks every single year. These are called required minimum distributions, or RMDs. And here's where most people get tripped up. They either completely forget about this requirement, or they take the money out late thinking they can catch up later. Wrong. The penalty for messing this up is absolutely brutal. We're talking a 25% excise tax on whatever you failed to withdraw. That's nearly double what the penalty used to be, and this change came from the Secure 2.0 Act. So let me paint you a real picture here. Let's say Robert, who's 75 years old, has about $800,000 in his traditional IRA. His RMD is supposed to be $35,000 for the year. But Robert gets busy, he's planning a trip, his grandkids are visiting, and he just kind of forgets about it. He doesn't take that $35,000 out. Well, when April comes around and he realizes his mistake, what happens? He's hit with a 25% penalty on that $35,000. That's $8,150 he now owes to the IRS, just in penalties. And then, on top of that, he still has to withdraw that $35,000 because the requirement doesn't just disappear. So now he's lost money that could have been in his account, compounding for him. And here's something most people don't understand. If you have multiple retirement accounts, this gets even more complicated. Let's say you have an IRA at your bank, another IRA at a brokerage firm, a 401k from an old job, and a 403b from another job. You have to calculate your RMD from each account separately. But here's the thing. You can aggregate your IRAs and take the total from one or more of them. But your 401ks and 403bs, those are separate. You have to take the RMD from each one individually, miss just one of them, and you're paying that 25% penalty on that account. It's easy to see how this could spiral quickly if you're not organized. Now, there are some exceptions. If you're still working at the company where you have a 401k and you own less than 5% of that company, you might be able to delay your RMD from that specific plan. But this only applies to your current employer's plan, not IRAs and not 401ks from previous employers. So if you left your job 5 years ago and have an old 401k sitting around, you still have to take the RMD from that, even if you're still working somewhere else. The solution here is straightforward. Mark it on your calendar, set multiple phone reminders, talk to your financial advisor or CPA about your RMD calculation. Don't let this one slip through the cracks. Now let's talk about the second trap, which is deceptively sneaky. A lot of people think Social Security benefits are completely tax-free. I run into retirees all the time who say, well, I paid into Social Security my whole life, so it shouldn't be taxed. I understand the logic, but unfortunately, that's not how it works. Depending on your combined income, up to 85% of your Social Security can actually be taxable income. And this is where it gets really dangerous. Your combined income is this special calculation that the IRS uses. It includes your adjusted gross income, plus any non-taxable interest you earn, plus half of your Social Security benefits. And here's the kicker. When you're taking RMDs, when you're withdrawing from your IRA, when you're realizing capital gains on investments, all of that gets added into this combined income calculation. So a withdrawal you thought was totally separate from your Social Security, it actually affects how much of your Social Security is taxable. Let me give you a real example because this is so important. Let's say Margaret is a widow. She's 74 years old, and she's married filing separately from the previous year's taxes. Her adjusted gross income is about $32,000. She's got $20,000 in Social Security benefits coming in. So her combined income is $32,000 plus half of her Social Security benefits, which is $10,000, so $42,000 total. She's under the first threshold of $44,000 for single filers, so she thinks she's safe, right? Her Social Security won't be taxed. But then in January, she needs to take her required minimum distribution from her IRA, which is $20,000. Suddenly, her combined income jumps to $62,000. She's now $18,000 above that $44,000 threshold, and now up to 85% of her Social Security is taxable. Instead of having completely tax-free Social Security, she might owe taxes on $15,000 to $17,000 of her Social Security benefits. That could be an extra $3,000 to $4,000 in taxes she wasn't expecting. And here's something else. Margaret's situation could have been completely different if she'd planned ahead. If she knew her RMD was coming in January, maybe she could have done a charitable contribution from her IRA in a different year, or she could have timed some other income differently. The whole point is, these decisions don't exist in a vacuum, they're all connected. The solution is to think strategically about your withdrawals. If you're going to take a large RMD in a particular year, maybe you defer other income if possible. Some retirees even consider doing Roth conversions in lower income years to reduce their future RMD obligations, which gives them more control. And if you're still working part-time or earning any income at all, that factors in too. Now the third trap, and this one is absolutely infuriating because it affects your healthcare costs, which are already astronomical. Your Medicare premiums are not based on what you earn this year. They're based on your income from 2 years ago. This is called IRMAA, Income-Related Monthly Adjustment Amount. And what this means is that your Part B premiums and your Part D prescription drug premiums can go way up based on income you earned back in 2024. Here's why this is so dangerous. Let's say you retire in 2025 and you decide you want to do a Roth conversion with $100,000 of your IRA. That makes sense from a tax perspective in some situations. But that $100,000 goes on your 2025 tax return, which gets used to calculate your 2027 Medicare premiums. You won't find out about the premium increase until late 2026 when you get your new Medicare notice. By then, you've already done the conversion and there's not much you can do about it. Let me walk you through what the income thresholds look like for 2026. If you're a single filer and your modified adjusted gross income, and this is a slightly different number than your regular AGI, exceeds $103,000, your Medicare Part B premiums go up. For married couples filing jointly, it's $206,000, and these aren't small increases. At the highest income tier, you could be paying $800 or more per month just for Part B. Add your Part D prescription drug premiums on top of that, which can also increase, and you could be looking at an extra $200, $300, even $400 per month in Medicare costs. Over a year, that's $2,400 to $4,800. Over a 10-year retirement, that could be $25,000 to $50,000. Let me give you a concrete example. Let's say David and his wife Sarah are 68 and 66 respectively. They've just retired. Their Social Security combined is about $48,000 a year. They have investment accounts that generate about $30,000 in dividends and capital gains. So their modified adjusted gross income is about $78,000. They're happily under the threshold. But then David's 401k has a distribution option where he can take a lump sum payout of $200,000. He thinks, great, I'll use this to pay off the house and have some cushion for emergencies. He takes the $200,000. Now his income for 2025 is $278,000. Flash forward 2 years to 2027, and when his new Medicare statement arrives, his Part B premium has jumped from about $170 a month to $560 a month. Suddenly, he and Sarah are paying nearly $400 a month in Medicare premiums instead of about $340. That's an $1,060 monthly increase, or about $12,720 a year. And this will continue for as long as their income stays elevated. The solution is to plan ahead. If you're thinking about taking a big lump sum from a 401k, consider spreading it across multiple years. Do Roth conversions in lower income years. Understand that capital gains realization, RMDs, IRA withdrawals, all of it factors into IRMAA. This is another case where strategic planning, sometimes years in advance, can save you tens of thousands of dollars. The fourth trap is what I call the capital gains multiplier effect. Now on the surface, long-term capital gains rates look pretty good. You've got 0% if your income is low enough, 15% for most people, and 20% for high earners. But here's what most retirees don't understand. Your capital gains tax rate depends on your total taxable income, which includes your RMDs, your Social Security, investment income, all of it combined. So that gain on your stock portfolio isn't taxed in isolation. It's taxed alongside everything else. Let me show you how bad this can get. Let's say Tom is 76, retired, and he's been holding on to some Apple stock that he bought back in 1995. The cost basis was $2,000, but it's now worth $27,000. So he has a $25,000 long-term capital gain. He thinks, I'll pay 15% capital gains tax on that. That's $37,750, and I'll have $23,250 left over. Seems straightforward, right? Wrong. Tom also has Social Security income of $30,000, an RMD of $40,000, and some dividend income of $15,000. His total taxable income is now $85,000 before realizing this capital gain. When he sells the stock and adds that $25,000 gain, his income goes to $110,000. Here's the problem. The 15% long-term capital gains bracket in 2026 for single filers maxes out at about $47,000 of income. So the first part of Tom's gain, about $12,000, is taxed at 15%, but the remaining $13,000 is taxed at 20% because it pushes him into the higher bracket. So instead of paying $3,750, he's actually paying about $4,350. That's $600 more than he calculated. But wait, it gets worse. That extra $25,000 income also affects his Medicare premiums. His modified adjusted gross income goes up by $25,000, which pushes him over the IRMAA threshold. His Medicare Part B premiums go from $170 a month to about $380 a month. That's an extra $2,220 a year. So his actual cost for realizing that $25,000 gain isn't just the extra $600 in capital gains tax. It's the $600 plus the extra Medicare premiums. Over 2 years, because IRMAA uses 2-year-old income, he could be paying $5,000 in extra Medicare costs. That means his real tax cost on the $25,000 gain is about $5,600 instead of $3,750. That's nearly a 22% effective tax rate instead of 15%. And if you're in a state with a net investment income tax, California, Connecticut, Illinois, Maine, Maryland, Massachusetts, Minnesota, New Jersey, New York, and Vermont all have this, you're paying an additional 3.8% on top of everything else. New York residents, for example, would be paying both federal capital gains tax and New York State's NIIT, which compounds the problem. And here's something else. If you're married but filing separately for some reason, your capital gains tax brackets are much narrower. The 15% bracket for married filing separately maxes out at about $25,000 instead of $89,000. So you'd be paying a much higher rate on those gains. The solution is to think in terms of total tax impact, not just capital gains tax. When you're thinking about realizing gains, you need to model it with a tax professional. Sometimes it's smarter to harvest losses strategically to offset gains. Sometimes it makes sense to spread gains across multiple years. Sometimes it's actually better to hold the position and not realize the gain at all. The point is, don't make these decisions in a vacuum. The fifth and final trap, and this one applies if you're charitably inclined, is the charitable giving trap. You want to give back. You care about causes. That's wonderful. But the way most people give actually creates a massive tax inefficiency, and they don't even realize it. Here's the situation. Most retirees take the standard deduction. For 2026, the standard deduction for a single filer is about $15,000, and for married couples filing jointly, it's about $30,000. So if you're just taking the standard deduction and you make a $5,000 charitable gift, that gift doesn't reduce your taxes at all because you're not itemizing deductions. You're giving away $5,000, but you're getting zero tax benefit from it. And even worse, that $5,000 had to come from somewhere. If you took it from a taxable investment account, you might have realized capital gains. If you took it from an IRA, it counted toward your income and might have triggered IRMAA or made your Social Security taxable. Let me walk through a real example. Patricia is 75, single, and she gives $8,000 a year to her church. Her itemized deductions, which include mortgage interest, property taxes, and other deductible expenses, add up to about $12,000. So she takes the standard deduction of $15,000 instead because it's higher. Her charitable gift of $8,000 gets her zero tax benefit. She's giving that money away for no tax advantage whatsoever. But here's the thing Patricia could do instead. She could use her IRA charitable rollover. If you're over 73 years old, you can transfer money directly from your IRA to a qualified charitable organization up to $100,000 per year. This money comes out of your IRA and goes straight to charity. It counts toward your required minimum distribution, so you fulfill your RMD obligation. But here's the magic part. It doesn't show up as income on your tax return. It's not added to your adjusted gross income. It doesn't trigger IRMAA. It doesn't make your Social Security taxable. It's the single most tax-efficient way to give away money from a retirement account. So if Patricia did an IRA charitable rollover of $8,000 instead of just writing a check, she would avoid any income tax consequences, she would fulfill part of her RMD, and her charitable gift would be exactly the same. She'd be way ahead. Or another strategy is what's called bunching. Let's say you want to give $8,000 a year to charity, but your itemized deductions are less than the standard deduction. What you could do is bunch multiple years of charitable giving into a single year. So instead of giving $8,000 every year, you could give $24,000 in year 1, 0 in year 2, and $24,000 in year 3. In the year you give $24,000, your itemized deductions might exceed the standard deduction, so you actually get a tax benefit. Then in the other years, you take the standard deduction, the math might work out better overall. There's also something called a donor-advised fund where you give money to the fund, get an immediate tax deduction, but then the fund distributes to charities over time. It's another way to optimize your giving. The point is, if you're charitably inclined, don't just write checks. You're leaving money on the table, plan it strategically. So here's what I want you to take away from all of this. Retirement taxes aren't just about filing a form in April. They're about strategic planning, sometimes years in advance. One bad decision, taking an RMD late, realizing a huge capital gain without thinking about IRMAA, giving to charity without structure, could cost you tens of thousands of dollars. But one good decision, spreading your income strategically, timing Roth conversions, using an IRA charitable rollover, could save you just as much. This is stuff that can genuinely move the needle on your retirement lifestyle. If your situation is complex, and most retirees' situations are complex once you have multiple income sources and multiple accounts, you really should talk to a tax professional or a financial advisor who understands these issues. This isn't something to wing. If you found this helpful, I'd really appreciate it if you'd hit that subscribe button and ring the notification bell so you don't miss our next video, where we're going to dive into specific tax-efficient withdrawal strategies. We'll show you exactly how to model different scenarios so you can make the best decisions for your unique situation. Thanks so much for watching, and I'll see you in the next one.